Hello everyone, how are you all doing? I hope you all are good. My name is Tona V75. Firstly, I'd love to thank God for the privilege to be able to share the knowledge I've gained over the years trading the synthetic indices market with you guys. Secondly, I'd love to thank you all for believing in me and subscribing to my YouTube channel and also trusting in my skill. Alright, so in order not to waste your time, I will just get straight to it. Okay, so the synthetic indices market is a very unique market, and I decided to create this YouTube channel to share the knowledge I have acquired over the years trading the synthetic indices market with you guys. I see a lot of traders have been struggling with the synthetic market, and I decided to make these videos to guide the newbies coming into the market and also impart knowledge to those who have been here for a while. So under Forex, we have the currency market, the synthetic market, and other markets as well. Now, most traders are familiar with the currency market due to the currency market have been in existence for a while. And the currency market is controlled by different fundamental factors. For example, it is controlled by news, controlled by the market makers, controlled by banks. The market opens on Monday and closes on Friday. Now, most traders are free during the weekend to trade, but they can't due to the market closed already on Friday. While on the other hand, the synthetic indices market are unique indices that mimic real-world market movement, but with a twist. Now, the market is not controlled by news, or the market is not controlled by market makers or so. It only mimics real-world market, and these indices are based on cryptographical secured random numbers generator. Now, the indices have constant volatility. This means these indices are very volatile. Yeah, so I will love to show you guys a few things on MT5, and I believe this is going to help you in your trading journey too. Okay, so here on my MT5, we have different indices that are available for traders to trade. We have the crash and boom, we have the step index, we have this range break, we have the jump indices, we have the DEX indices, the drift swifting indices. Where most traders get it wrong, they have the mentality that they can trade all the pairs or all indices they see on their screen, which is totally wrong. Now, note that there are days to trade. There is a time to trade. There is an hour to trade. You don't just enter the market and execute a trade because you feel like or due to you have the money to. Firstly, let's check out the Boom 1000 index. Now, a spike occurs in the course of every 1000 ticks here in the boom market. This Boom 1000, remember. Now, you notice something. You notice we have short red candles and then we have long green candles. Now, this pair spike upwards in the course of every 1000 ticks. Based on my own personal experience here, I won't advise you to trade the Boom index, whether as a newbie or as a professional trader. I won't advise you to trade the Boom index. And now I see some pairs as you are gambling and you are not trading. I hope you guys get it. You are gambling and you are not trading. Okay, so look at this. This is the Boom 1000 pair. Now imagine you decide to take a sell from this level. Now you execute your sell trade and market decides to sell from this point all the way down to this point. And you are in profit already, and you are happy and, you are focused on other things. And all of a sudden, you open your chart and you see this, boom, from here, market decides to spike from this point to this point. This is a heavy spike. And this spike is capable of either causing serious damage to your account or even blowing up your account. It depends on your lot size, your entry point, and these things I mentioned, and other important factors like that. So I won't advise you to trade this pair because, to me, based on my personal experience, I don't see you as a trader. I'll see you as a gambler trading this pair. And then when you see most people that trade this pair, they are always like, oh, I want to catch the spike. I want to catch the spike. You can't be the one to decide where the market will spike from. The market itself decides that. Now, I won't advise you to trade this pair. Based on my own personal experience, I will say this pair is you not trading. I'll say I see it as you gambling. Now, same thing applies to the crash index. The crash index is the opposite of the boom index. Now, the crash index doesn't spike upwards, it spikes downwards. And there is an average of one drop. When I say one drop, I mean one heavy downward spike. There's an average of one heavy downward spike in the course of every 1,000 ticks, also on the crash 1,000 index. Now, imagine same thing happen on this pair. It is just the opposite of the boom pair, but this pair spike downwards. I won't advise you to trade this pair also. Remember, I said based on my own personal experience, I don't see it as you are trading. I see it as you are gambling. Yeah, I see it as you are gambling. Now, the only way you can trade this pair profitably is if you are very good with the candles on the higher time frame. And most traders, 80% of the synthetic traders we have are not so good with candlesticks yet. For someone like me, I can trade the boom and I can trade the crash index. Yeah, but then for newbies, I won't advise you to trade this pair. And even for those who have been trading for a while, I won't advise you to trade the boom and the crash index. Due to these pairs spike, they are very volatile and they can either cause serious damage to your account or blow away your account. And one thing I've come to notice, one thing I've come to discover is also the stop loss being used for these pairs doesn't work as it is as it should. It doesn't work as it should. I will explain that later to you guys. Now, I also want you guys to note that we have the jump indices. Now, as for the jump index, the market doesn't only spike towards one direction. The market spike both ways. There's always a spike going both ways. It may be a buy spike, it may be a sell spike. Now, the thing with trading jump indices and the crash and boom indices is that trading this index here, if market should go towards the direction you predict the market will go, you make a lot of money. But if the trade should go south, you are likely to lose a lot of money. And I won't advise newbies to trade this pairs because you can lose the whole capital you have funded through trading these pairs. Before you can trade these pairs, you must be very good with the higher time frame. Yeah, you must be very good with the H4 candle, the daily candle, 1 hour candle. You must be very good with all these candlesticks before you can execute trades on pairs like this. Now, I used to be very good trading now you can see a spike just happened here. That is what I mean by a spike. Now, imagine I took a buy from this point. This spike you see that just happened, decides to happen. This spike is capable of wiping away my account. It is capable of causing serious damage to my account, and it's due to this reason. In fact, stop loss won't work at this point. Stop loss won't. So it is due to this reason I advise you guys not to trade pairs like this, except you are very good at it. As for me, I am very good with the jump index. Very good, but I just decided to stick with V75. And I'll let you guys know my reason for trading only V75 as we proceed. Now with this jump 25 here, as at last year, January, I flipped a $50 account to about $12,000 on jump 10. I was here. Yeah. Now, this was the day I executed the trade.
Trade was still running here. You can see my entry. This was my first entry. Now, I actually started this account from $50, not $250, and I moved it from $50 to $1,000, and I think over $1,000, yeah. And I withdrew part of my profits and left I left $250 on the account, yeah, 250. And then after that, I added more positions to the trade, and now this was a trade that opened my eyes to the strategy I used to trade V75 now. After this trade, I was like, wow, this is real. It was this trade that made me start backtesting the synthetic market, because look at my entry. I have a zero drawdown, and I've never executed such trade before.
We also have the volatility index. We have the drift and so on, but those are new index that just got released by Derive. I'm talking about the drift, the basket index, and so on. But the main indices that traders are familiar with is the jump indices, the boom and crash indices, and the volatility indices. And I will focus more on the volatility indices. Now, I have advised you guys not to trade the boom and crash indices. Now, let's see the volatility indices. Now, the only indices I can advise you guys to trade is the volatility indices. And when I say the volatility indices, I'm talking about volatility 10, volatility 100, volatility 151s, volatility 25, volatility 50, 75. Now I can advise you guys to trade the volatility indices. All volatility indices move in such a way that you can trade it without being scared or having the fear of a heavy spike happening that will wipe away your account or wipe away or cause serious damage to your capital. Now, also note that the lot sizes for the synthetic indices market is far different from the lot sizes of the currency pair market. And due to this, a lot of traders come into the synthetic indices market and boom, they lose their account at a go. Now, the issue is the lowest lot size for the currency pair market is 0.01. And after that, we have 0.1. And I think we have the standard lot size 1. But for the synthetic indices market, each pair have a different lot size. Now, studying the lot sizes for synthetic indices market or in the synthetic indices market is a course on its own. You have to spend time knowing the lot size of each pair. And we have the volatile pairs, we have the non-volatile pairs, we have the less volatile pairs in the synthetic indices market. So you need to know all this first before you dive into the synthetic indices market and start trading it. Now, firstly, I'll advise you to spend time trading all the volatility pairs you see here on my screen. Volatility indices. At some point, you come to discover you prefer trading a particular pair or trading one or two particular pairs than other pairs. And I will advise you stick to the pair you prefer trading the most. Stick to the pair you love trading the most. Now, one thing I've come to also discover is that the market repeats the same thing daily. It repeats the same thing weekly, the same thing every hour, repeat the same thing every minute. Now, the secret to being a profitable synthetic indices trader is to discover the things the market repeats. You need to discover the things the market repeats on the particular pair you love trading the most. Remember, the market isn't controlled by news, isn't controlled by the market makers, isn't controlled by the banks. The market is only mimicking the real world market. Now, remember I told you guys that the market is controlled by generated cryptographical numbers. Now, I've come to discover the market repeats the same thing. Like I said, what you should be after is knowing the things the market repeats. Now, before you get to this level in trading, before you get to the level of being of preferring to trade only one pair or becoming very perfect on one particular pair, there are things you need to know. There are other things you need to perfect. There are things that you need to be good at already before you get to the level of sticking to one pair. And for example, one of those things is you need to know the powerful reversal candlesticks in the market. You need to perfect your trading psychology first, and you need to perfect a few other things, which I will be talking about in the next video I will drop on the channel. So please do good to watch the videos I'll drop next. There are things you need to know in the forex market. There are other things you need to perfect in your trading journey, and these are the things that will help you in executing trades perfectly when you finally decide on what pair you want to trade. Firstly, I will advise you to perfect your trading psychology. Yeah, that's very important. Your trading psychology. You need to also be very flexible with candlesticks. You must be able to know the movement of candlesticks from 1 minute time frame to monthly time frame. You must be very flexible with candlesticks. Very flexible. Now, all these things cannot be achieved except you decide to sit down, get a pen, get a book, and backtest the market yourself. Execute trades yourself. You can pay 1 million people to learn how to trade and still not gain anything at the end of the day. The secret to becoming perfect in this market is you learning it yourself. You pick up your phone, try trading at least 3 hours in a day. Just be on the market on a demo account, not a real account, because you don't have the skill yet. You can't make money from a market you don't have concrete knowledge about. Do you understand? So you have to pick up your phone or pick up your system, your laptop, and analyze the market yourself repeatedly. And believe me, you tend to discover things yourself, even things no one will teach you. You'll be able to discover all that yourself. So in the next video I'll be dropping, I'll be talking about candlesticks, not candlesticks, but the powerful reversal candlesticks you need to know, and also your trading psychology. I'll be talking about the things you need to perfect first before you decide to stick to one particular pair in the synthetic indices market. All right, thank you so much. God bless you.